chart we'll look at is going to be perhaps the biggest of the reversal versus pullback questions. That's going to be the S&P 500. Now, in terms of scale, this has been quite a remarkable break. All right, we've had a move that initially broke earlier this, or actually at the late January, with a break here of this very tight wedge. We had a continuation move beyond this very substantial previous resistance, now new support level, and ultimately this move has ended up to be over 5%. So a 5% drop to the downside can certainly, on a scale like this, if I were just looking at a chart of this amount of price history, would look like a reversal. However, we have to put this into context. We have to look at the bigger picture. Because when I pull this all the way out to the past 5 years, we can see that there is generally a much larger and impressive bull trend. And this 5% plus correction really doesn't measure to all that much when we see it in this context. All right. Now, that's not to mean that we aren't going to get a more significant turn. The conditions are there, fundamentals are there. The market conditions are starting to get to that level, and certainly the technicals are offering us Q upon Q of that continuation. And always, a true reversal initially looks like a mere correction. It's the level of conviction that picks up that ultimately turns it from a limited pullback into a more significant move to the downside. Right? So looking at the correction that we see now, how often have we seen these substantial pullbacks in the past 5 years? Well, a 5% plus correction. We've had a number of those, but we have also seen moves of 10% and 15% pullback in that series of time. We have not seen a dedicated bull wave since the great financial crisis back in 2007, 2008, though. All right, having a 20% plus pullback in the market or drop in the market is, by many people's estimates, a bear wave. All right. Will we hit that very early in the assessment now? But I want to talk about the conditions that we can use to measure this, because we can use these same conditions on pairs like the euro and dollar yen. Really, truly all the yen crosses. The pound dollar, which has recently had a very significant technical break and put many on high alert of a more prolific reversal. Or the euro dollar, a pair that I am actually trading and already short. We've had a noteworthy technical break here. Is this something that's going to be more significant in a turn? All right. Well, let's look at the aspects of a pullback versus a reversal so that we can establish what would give us confidence in that kind of scale. All right. First thing to realize and to recognize and to trade around is the fact that you'll never be 100% certain. If you are 100% certain, you're in the wrong field, you're in the wrong industry. We should never be 100% certain of anything in trading because there is no certainty. There is only a scale of probability. And in that scale of probability, we should establish what kind of probability do I need to make a trade. Some people, it's 51%. All right, I just have to be better. I have to have enough confidence that it is slightly more likely to go in my direction than it is to go against me, and I'll take that trade. Some people need 60. Some people need 70. Some people need 90. All right, for those people that need 90% probability or certainty, there is going to be a very high probability that you're going to miss out on at least some percentage of the new trend, whether you're talking about a pullback and follow through or whether you're talking about a reversal. That's just something we have to live with. And that doesn't necessarily make it a bad strategy, because we can adapt our level of confidence. And let's be honest, if I make 90% of my trades but there's smaller returns, that's still a comfortable strategy. For many people, though, the risk threshold is lower on that scale. They're willing to take a little bit more risk for a little greater rate of return. All right. So the probabilities are always the most important consideration, first consideration that we have to work with. From there, we can start looking at the more mechanical stuff. First, technicals. All right, we looked at the S&P 500, and we know that we have this pullback of approximately a 6% correction, and it does fit within a much larger trend. All right. Now, the probability is that this trend, which has been in place for 5 years, is going to maintain its bearing. All right, it is just a better probability for what we've seen in historical performance. However, probability does not necessarily equate to potential. Does this have more potential? All right, will you have greater return if it moves to the upside, or would the returns be greater if it continued to the downside? We are at or just off of record highs, and the continuation to the upside, as though it has been pretty consistent over the past few years, has been more reserved. It has been a slower climb. All right, consistency comes with moderation. On the other hand, these markets are significantly levered into this performance. A chart that we've seen very frequently is the amount of leverage being used to drive this S&P 500 higher. All right, and when we talk about the fundamental aspects here, all right, the underlying conditions as well, disorderly unwinding of exposure like this, and knowledge that participation levels are exceptionally low, 15-year lows, in fact. 15-year low participation, record amounts of leverage, that creates a scenario that if this indeed does continue to trip lower, you're going to hit stops. People are going to get out of their trades, and the leverage means that the leveraged gains are also going to equate to leveraged losses. All right, so people will get out more aggressively. They'll unwind more aggressively, and that leads to what we call a cascading exit. That is a more aggressive, more destructive decline. So potential is far greater to the downside. Probability is still favorable of the upside move. However, as we can see in this technical progress here, the technical break first of this trend line, or this wedge pattern, was the first level of probability rising in favor of a more bullish theme. Breaking this very long-term trend line, all right, that was the next important level. Now, the next one that I have on my chart is going to be 1740 as a fib, all right, 38-2 fib of this up wave here, bull wave here, as well as this trend line that has been in place since the beginning of 2013. All right, so I'm looking at technical cues. Each technical cue that breaks, it's more likely that we have a more dominant bear theme. All right, so it's not just a pullback. It's more likely to be a lasting bear wave. All right, so the technicals are the first aspect. All right, we can also look at the fundamentals. The fundamentals, as we are, what is important to establish is the thing that has driven this higher, that has established this bull trend. Whether we're talking about the S&P 500, whether we are talking about the yen crosses, whether we are talking about the euro-dollar advance. The thing that has developed that trend, is it still in place, or is it starting to fall apart? That's extremely important to establishing your sense of probability from, or transition from correction to reversal. All right. For the Euro USD, the euro has done very well in its performance, in large part due to the position of the ECB first coming in and stabilizing the financial uncertainties in the region, and then with the ECB reducing its balance sheet. So there's a relative monetary policy advantage to the euro. Well, now that this advantage has come under threat. The Fed is tapering. The ECB, on the other hand, is expected to potentially increase its stimulus effort to kind of to front run some potential problems down the road. So you're starting to see an erosion of that bullish fundamental appeal. Pound dollar. A lot of expectations on an early Bank of England rate hike sometime in 2014. All right, those expectations have hit exceptional levels, and essentially the market's fully pricing it in. Now there is a very open field for this this currency to be undermined in its expectations. If anything comes in that suggests that no, they will not hike in 2014, there's a lot of room for this to unwind. There's more limited room to the upside. unless there is a Bank of England adoption of an aggressive rate hike regime, which is very unlikely. All right, so these have potential versus probability issues, not just in technicals, but in fundamentals as well. Yen crosses. This is the Bank of Japan's territory, the depreciation of the Japanese yen, or the rise in these yen crosses. And we know that the Bank of Japan is a pretty good probability of expanding its open-ended stimulus program. But that time frame is becoming somewhat uncertain. Furthermore, if risk aversion kicks in, the yen crosses will follow their typical risk roll. Right, we know the correlation between something like the dollar yen and the Nikkei 225, which is the Japanese index, is exceptionally high. Why? Because you need positive risk assessment for people to invest in what is essentially a carry trade. Yes, the depreciation of the yen is something that will drive the currency down, but it's rendered effective because risk trends are positive. If risk aversion kicks in, that will easily offset the Bank of Japan's efforts. At the very least, it will create difficulty and trouble the trend. All right? And of course, the biggest question that we have, the fundamental backing of this S&P 500. There have been many issues that I've brought up for this continued drive. Economic outlook moderating, all right, expectations for yields rising, amount of returns from both investors' perspective as well as corporate perspective. All right, a lot of issues. My biggest concerns, though, are not necessarily through these standard fundamental themes, but more so through those market condition backdrop considerations. All right, the use of leverage, the expectation that stimulus would always remain in place, and in turn lower the presumption of risk for individual investors. So people would always expect low volatility and thereby are capable and willing to take on greater risks, trying to make returns at the presumption that they're not going to suffer the risks that come along with those returns. All right. This also has a very fundamental bearing, and it does change with the Fed reserves change. All right, we've talked about the risk aspects in a number of times in the past weeks in both the strategy and the trading videos. You can see more about it there. But I do think that this is perhaps one of the highest probabilities of turning this market around from not just a correction, but into a true bear trend, all right, true reversal that we've seen perhaps since the beginning of this long-term bull wave. So the things that we need to watch to establish whether this is indeed going to continue its move to the downside. Technical breaks. Right? We've already had a couple that were very influential. Those raised the probability. We need to see further technical breaks with each subsequent break. You know that we're shaking out people that aren't confident in highly leveraged positions, and that's going to feed the move to the downside. All right? And we also have to consider the other conditions that will help push this down. Not just the S&P 500, global equities, Nikkei 225, FTSE 100, seeing the yen crosses as the carry trade measure for risk trends, seeing the high-risk emerging market currencies performance. All right? Risk is a very big theme, and seeing and measuring a correction or a pullback in this or a reversal in this is the foundation for establishing a lot of trades. Right? So when we look for these pullbacks versus reversals, this is something we can do on a very big scale like we're doing here, or it's also something we can do on an hourly chart. Right? But always remember, it's a situation of probabilities, and there is a technical, fundamental, and market condition pattern behind it. Just being able to align those three factors such that the probabilities are in your favor and fit your risk profile. That's what you're trying to do. That's what you're trying to accomplish with this assessment. All right? Keep your eyes on these markets. These are very great times to be trading, and hopefully we see some more activity going forward. Good luck trading out there, guys, and we'll do another strategy video tomorrow.